Hello and welcome to your October investor update from Nutmeg. I'm Kat Mann, Savings and Investment Specialist and Head of PR here at Nutmeg. And after months of filming our investor updates remotely, today James, our Chief Investment Officer, and I are back in the office for filming. While the rest of the team continues to work remotely, James, it is lovely to see you.
Hi Kat, great to see you too.
James, world equity markets had their best month in August for 30 years, with some markets being back in positive territory year to date. But with fears of a second wave of coronavirus and the upcoming US election, how was September for the markets?
Well, that's right, Kat. So September was a much more volatile market for equity markets globally. If you remember how we started the month, we come into September on the back of one of the best August month performances in over 30 years. In fact, the best since 1986, particularly for US stock markets and the growth focused NASDAQ index with so many of those technology names that we know in there. And as we moved into September, really markets struck a little bit more of a pessimistic tone, giving back some of the gains that they achieved in August. A sustained rise in COVID infections in Europe, the political discord in the US, potentially delaying any fiscal stimulus or further fiscal stimulus until after the US election, and also the outcome of the election itself, what's looking to be a very close contest at this stage in the race, and with the potential for a delayed outcome in result.
So when we look at the numbers, not a good month for markets.
Mainland Europe actually fared a little bit better than US markets, with returns of around negative 1.8%. And in the UK, we saw stock market returns of around negative 1.5%. But it was really emerging markets that shone, outperforming the developed markets, still with negative returns, but around half of the loss of the developed markets index at around 1.6% negative for the month. And that negative sentiment also fed through to the bond market. We saw relatively muted gains in investment grade, higher rated corporate bonds, and losses of around 1% in those higher risk, high yield segment of the corporate bond market. And in that environment, as you might expect, government bonds delivered modest returns for investors, slightly positive on the month as investors sought to find greater diversification and safe havens in portfolios. And closer to home, the UK's internal market bill also unnerved investors at a really critical time for the Brexit negotiations, and that saw the pound sterling weaken against the euro back towards the lows that we've seen post-Brexit.
Thanks, James. Now, you've mentioned tech stocks there. We've seen a lot in the news about different sectors and industry that are driving the market, most notably tourism and aviation on the negative side, and then on the positive side, the tech stocks. What are the factors that are driving market activity at the moment?
Well, I think when it comes to sectors in the economy, there really is a large dispersion between different industries and business models, and the way that they're affected more or less so by some of the restrictions that have come into play in society in the last 6 months. But it's also really important to know that it's also true at a stock level. Not every company in highly affected sectors has underperformed as severely, and not all companies in less affected sectors have had such strong performance. And that dispersion is something that we see not only in the corporate world, but also in some of the economic measures. So when we look at in the US personal incomes have actually risen in the first 6 months of this year, and that's largely been driven by the impact on certain sectors of the labour market. So low-income workers have really been disproportionately affected by job cuts. That's led to those extended employment benefits contributing to a rise in personal incomes in the US. Similarly, in the UK, we've seen dispersion in the UK labour market. So we've seen a real disparity in the effect of employment on younger age groups versus larger age groups, and also on part-time workers versus full-time workers. Full-time employment is actually holding up relatively well in the UK at present. And this really speaks to the real true unevenness of the recovery that we're seeing at the moment, and the unevenness of the effect of what's taken place on certain industries or business models or sectors in the economy. And we only have to think of some of the sectors such as travel or hospitality that may correlate with some of those labour market statistics to understand that. And I think this is really going to be a key theme going forward, and a key focus for policymakers is how do they treat this unevenness. And we're seeing already in the UK an approach from the Chancellor to potential further stimulus or potential further support packages that are much more focused on retraining or potentially reshaping areas of the economy, rather than simply just providing stimulus to secure existing jobs. It's about evolution as much as it is about protecting jobs in the economy today.
So it's quite a complicated picture.
That's true. It's incredibly complicated and the data is incredibly difficult to see at the moment, but we are seeing these patterns emerge and those patterns are probably what we would expect, knowing what we know about which sectors are most affected.
Brilliant, thanks. So against this backdrop and with so much going on, how have the Nutmeg fully managed portfolios performed?
Well, as you may expect, given what we've covered in terms of market behaviour in the month, portfolios did give back some of the returns that they've gained over the summer in September. And that means for our fully managed portfolios, returns for the month of around negative 0.2% in our low risk portfolios, negative 0.85% in our medium risk portfolios, and negative 1.2% in the highest risk portfolios. For our socially responsible portfolios, that means returns in the low risk category of around negative 0.3%, in the middle risk portfolios of around negative 0.5%, and in the highest risk portfolios, relatively muted losses of around minus 0.6% for the month.
Thanks, James. And with all this going on, have we made any changes to the fully managed portfolios?
Well, we did make a number of strategic adjustments to our fully managed and our socially responsible portfolios in the month of September. So firstly, we took advantage of that weakness in equity markets to actually increase our equity exposure and bring it back in line with the long-term levels of equity risk for the portfolios. And then secondly, we also added a small holding in gold, and that was funded from TIPS or Treasury inflation protected securities. These are US government bonds with inflation protected and embedded in them. Those have performed relatively well actually in recent months as inflation expectations had rebounded. But we think gold is a really interesting asset class, and we think with government bond yields leaning towards their all-time lows in much of the developed market. So there's really a number of reasons we think gold is an interesting asset class at the moment, and we've actually written extensively on this recently on Nutmegonomics in various blogs, and also about the use of gold in our socially responsible portfolios.
Thanks, James. So well worth checking out if you haven't already. Now, we've already touched lightly on Brexit and of course the upcoming US presidential election. Are there any other big political or economical factors that could move markets between now and the end of the year?
Well, there are always many other drivers that can move markets, and we've actually managed to get quite far into the conversation this month without mentioning COVID-19 in any real detail. But clearly we are still in the midst of what is a significant health challenge globally, and that's likely to induce some more volatility periodically over the next 6 to 12 months. But that volatility could also be upside volatility as much as it could be downside volatility. So if we think about the potential for a vaccine in the next 12 to 18 months, if only even temporary, that could really lift markets if any sort of vaccine comes to the marketplace and a potential even short-term solution comes to fruition. I think policymakers are still really intent on driving a robust economic recovery here, and it's highly likely that recovery will require some further fiscal or monetary stimulus. The ECB is rumoured to be considering at the moment, the European Central Bank, whether it expands its quantitative easing programme. At the end of this month, we've seen the UK take further steps to support jobs with the retraining schemes and the reinvention of the furlough scheme into the remainder of the year. And we're also seeing continued negotiations in the US over a further fiscal package. So we'll see more support from policymakers, and that's really going to be integral to market sentiment. Amongst other drivers for volatility to the downside on the risk side, there's always further risks that some predictable, some unpredictable, that could come to fruition in the next 6 to 12 months. The thorny issue of US-China trade tensions is one that has laid somewhat dormant as coronavirus has dominated the news, but it's still present. And actually, a lot of investors will have a real keen focus on the US election to understand, which administration will be moving forward with power in the US and what that means for the future of that relationship and whether it could deteriorate further or whether we take a slightly more diplomatic route to negotiations.
For this month's customer question, Chris from YouTube has been in touch and he's asked, with the current rate of gains in the tech sector, would you consider reallocating portfolios in a heavier tech-friendly way?
Well, thanks for the question, Chris. And we do continue to have a strong bias towards US equity markets, and in particular those large cap technology companies that we feel can really continue to benefit from what is an open-ended and almost generational secular trend. And of course, we're also conscious of valuation when it comes to technology companies. But we think the environment today is very, very different to the environment that we saw in the early 2000s, where the prices of technology companies became inflated very quickly, and not least when viewed through the ability of these companies to generate profits, to generate strong return on equity, and also to generate cash flow. And I think this is a really important aspect, because rather than solely thinking about these companies with a growth focus at the moment, many investors are actually looking at the stability of the cash flows, the stability of some of these recurring revenues, alongside the growth aspects as being really attractive. And if you think about the subscription models that many of these businesses are operating, whether that's Amazon or Netflix or Microsoft, actually it does allow for an increasing level of recurring revenues and stability. But I think it's also important to think about the technology theme as also being a theme of digitalization. So much like Nutmeg is an investment business that's using technology to make its service more accessible and efficient, digitalization is driving greater competition, greater efficiencies, and evolutions of business models across industries. And if you remember that of the famous FANG stocks, the Facebook, Apple, Amazon, Netflix, and Google, now Alphabet, only one of those is actually technically classified in industry classifications as a technology company. So, they are great examples of cross-industry disruption through technology that are not necessarily just associated with the technology sector itself. Why not increase holdings? Well, long term, we've got to remember that the technology sector has been much more volatile than the broader market. And when we decompose our holdings across the entirety of our equity exposure, we do already have quite significant exposure to the technology sector and to some of those companies that are heavily ingrained in that digitalization theme and journey across the portfolio. So we need to balance our desire for higher technology exposure with the need for diversification. And there are, of course, also risks on the horizon. As with any sector, as with any industry, it faces its own challenges. Both of the potential presidential candidates have signaled that they would support further antitrust enforcement and tech regulation. So it's clear that the technology company is going to face more regulatory headwinds going forward. So it's a case of wanting to access that secular trend and that we find attractive over the medium and long term, but also balancing the diversification need and the need to acknowledge some of these short-term risks.
Thanks very much, James. It's been lovely to see you.
You too, Kat.
And thank you for joining us. If you've got a question for James or the investment team, or you've got something you'd like him to tackle in next month's Investor Update, then you can leave that in the comments section below, or you can contact us via social media or our email address. We look forward to seeing you again next month.